Our job as investors is to identify risk, learn how to mitigate it, take it out of the table, and give you a smooth return as possible, and create value by bringing alpha to the table.
Welcome to Deal Flow with me, Michael Pulio, the go-to destination for high-level private equity and real estate professionals, including institutional investors and market experts. I talk with industry professionals week on week on everything real estate and prop tech. Today, we're delighted to welcome Danny Kattan, founder of PIA Residential and 𝐶2rent.com, to our show. Danny is a seasoned real estate investor and entrepreneur who specializes in innovative and real estate investing strategies, including sale-leasebacks. With over 2 decades in the industry, he has significantly impacted traditional real estate practices, managing over 1,400 multifamily units and revolutionizing property transactions with 𝐶2rent.com. Danny, thank you so much for joining us today.
Thank you, Michael. It's a pleasure. And to everybody here in the show, thank you for your time.
Yeah. I'm excited for this conversation to get someone who's done apartments and single family and all sorts of great stuff. So although I gave you a little bit of an intro, if you could just kind of in your own words, bring us up to speed on your long and illustrious career thus far.
Thank you for the illustrious part. But yes, it's been a long career. I'm originally from Cali, Colombia, South America. That's why you hear the accent. I did industrial engineering in Northeastern, came back to Colombia, then did my MBA in Wharton, came back to Colombia, worked as an investment banker, and got seduced by the .com and started a .com company in the early 2000s and moved to Miami to do that. After that, got a little bit into telecom. And while I was in Miami, I started seeing the signs of a bubble. And I knew it was a bubble because it was kind of the same stuff when it was the .com, right? It's like you walk into any place and everybody's talking .com and doing deals on the back of the napkins. And you know when it's a bubble, when the money's just too easy, right? And I started seeing that, and eventually somebody said, yo, it's going to be like the, savings and loan crisis. When, the early 90s, late 80s, when, the government took over a lot of the banks and sold the loans for pennies on the dollar. Now, somebody tells you can do stuff for pennies on the dollar, your just brain goes haywire. So I started researching that, and I realized there's going to be an opportunity. So I'm a doer, right? Like I'm an engineer. I like to get my hands dirty. And I said, you know what? If I want to eventually go buy notes for pennies on the dollar or capitalize on the opportunity, I had to learn how the sausage is made. So I said, who's the largest producer of mortgages in the industry? It was Countrywide. I went to work for Countrywide in the pit. My boss, 2-3 weeks into my work, called me into his office, locked the doors, looked at me very seriously, and said, tell me, are you like a corporate spy? Are you writing a book? Why somebody like you is here? I'm like, what do you mean? It's like, well, you got the MBA and the investment banking background. What are you doing with people who barely got out of high school? And I'm like, well, Ray, I think this is going to hit the fan. And when it hits the fan, I want to learn how the sausage was made. He said, oh, you're crazy. 2 years later, in 2000.
Oh, yeah. I was going to ask you, what time was this? Okay, so this was 06 or so.
2006. Okay, 2006, right? Mm-hmm. When we're pitching the Nina loans, fuck the mirror. Oh, you're alive. Here's how many loans do you want, right? Things like that. Listen, a lot of people will say, oh, it was Countrywide pushing people. No, it was Wall Street pushing people like Countrywide to push people, right? And everything ends and starts with Wall Street in real estate, because those are the guys who create the vehicles to give us the money, right? Anyway, 2008. I went to banks to try to buy the notes, and then I realized that we can buy the underlying assets cheaper. That's when I called my current partner, Jimmy Levy, who's also from Colombia, second cousin of mine. He had a couple of franchises of We Buy Ugly Houses, and we started, buying one house at a time. It's like, hey, Michael, we're going to buy this house with your money. We're going to fix it. We're going to rent it, Section 8. You're going to have a cap rate, and it's your house. We're not partners. Just give me a fee. Because everybody was scared with the amount of things. Nobody wanted to hear about funds or, the market was very scary at that time, Michael. Like I wouldn't call it into a fist fight, but I got into an argument with a friend of mine and says, oh, you guys were lucky because you bought it the right time. I'm like, no way. We were the idiots who were buying stupid stuff at the wrong time, right? A friend of mine thought that I was going to get killed because, we were buying, not the safest zones. And so, that the seed story is we bought one house and then we bought another house, then we bought another house. And then you realize, holy crap, we need a property management software to track all these things, because back then there was no property management software for single families. And then we created a property management company, which is not a great business to be, right? And then we started creating a construction company. And before we know it, we were in warehouses and we had people in property maintenance and the whole thing. And, the business started evolving. And it was very interesting because the dynamics at the time was that the money was very, very scared. It was extremely scared, right? I sat down with a guy that I knew it was worth probably $10 to $20 million. And I says, why don't you buy one house? It was $100K. And guy goes, oh, but what if the market double dips? And I'm like, you idiot, if the market double dips, we're all screwed up. Wherever the money that you have is in whatever bank it is, it's done. Citibank was trading at $1, the banks were, being held by, tape. And so I wouldn't say that we were shooting fish on a barrel, because to shoot fish on a barrel, you need actually bullets. It was more like we were like trying to spear fish on a barrel, because, we went to the money people and the money people were really scared. And a lot of people don't realize this, but the single family asset class was started by Warren Buffett, at least in my opinion. When he came out and said, it's a good asset class, but not practical, I told my partner, this is the beginning of the end of the shooting fish on a barrel. Blackstone came on board. Funny enough, a friend of mine who had told me that I'm an idiot and I was going to get killed buying houses called me up and said, I met these guys from Blackstone. They're interested in talking to you. So, we ended up talking to Invitation Homes guys early on. And it was quite fascinating, because I was there in the rooms when this single family asset class was being created. Initially, people thought it was a trade. Let's buy some houses, hold them and fix them, and then, sell them. Now it's an asset class. I will say that, we rode everything until 2018. We created a portfolio of about 400 houses and 400 small multifamily doors, all in South Florida. I was the head of acquisitions. And so I literally walked in myself and sold 6,000 homes to buy 400. So I had to, I drove a lot. I saw a lot of homes. Back then we didn't send people to see things for us. We were very operational. And so 2018 comes up. And at that moment, one of the things that we knew about real estate is that, in our opinion, it kind of rests in three legs. One is you have to buy things below replacement value. That's basic. The second part is you actually have to buy things, where the cap rate is above your cost of capital, because otherwise, you have a negative carry. And the third part that I think that's most important for people to understand is that residential real estate actually is fairly easy to price. Because if you can afford a mortgage, right, and you can turn that you can afford a rent. If you can turn that rent into a mortgage, and with that mortgage, you can buy a house, right? That will tell you whether properties are undervalued or overvalued. In other words, if it's cheaper to buy than to rent, right, you should be buying as an investment. If it's cheaper to rent than to buy, then you should be selling, right? Because the properties are overvalued. And so we started tracking those things. And in 2018, we came to the conclusion that it was time to sell, because simply put, the cow was not worth the milk it gave. We're basic, like if you go back to real estate, before Wall Street invented all these things where you can put money into, people put it underneath the mattress, or they just bought bricks, right? And I come from Latin America, where people just basically bought the brick, and that's where, a lot of the people made their money, because, they will just basically buy something that it grew up with inflation. Again, inflation is, as people will not know it, but I call it it's a tax on your money. It depreciates with time. But if things cost more, so is the brick and so is the labor, and therefore real estate should go up. And do we believe that, for real estate to be valuable, the cash flow has to correspond to it? Now, you can argue that, we're going to buy here because the neighborhood's going to appreciate or the city's going to appreciate. But the bottom line, I think at that moment, 2018, we couldn't argue anything like that. We sold back then for about a 5.25% cap rate, which was very low. We sold for $250,000 per single family that we had in some of, C plus, B minus neighborhoods. And we sold because it was the right thing to do at the time. And we basically found a buyer, which was Cerberus Capital with First Key, and they bought, about half of our portfolio. Then the rest we sort of retailed. And we believed that we were in the right, happy. We took our money, and then we figured out, what do we do with this money? Now we have money, right? Now what do we do with this? And then we sat down and we said, is real estate, single family real estate or residential real estate, the best asset class? And so we started talking about the other different asset classes. And then when I opened my big mouth to my partners and I said, well, listen, all we know is that this is not going to get disrupted by technology. Like we will not have an Amazon effect. And so they're like, oh, Danny, you're just BSing. How do you know it's not? And so I started talking about the effects of technology in real estate. Like now it's clear that, oh, it's the Amazon effect. But Michael, will you buy a gas station today? Of course you will, probably, because you're going to be like, hey, it's electrical vehicles, right? But will you buy a self-storage? I don't know. Right now, I can tell you that because of self-driving trucks, maybe self-storage is not needed, or a warehouse, right, with a 3D printing machine might not be needed because, if you think about it, an auto parts warehouse, that it's going to be supplanted by a 3D printing machine. So all these things, we in real estate end up buying a lot of fixed assets with long-term planning, but we don't think in the next 5 to 10 years what is going to affect that asset class. So, and I think that, that's very important as we realize at the end that, residential was the safest place to be, because one thing that we had learned during the Great Recession, and for those of you who were not there, it was bad, man. I mean, I had professionals who couldn't find a job. They didn't have money to pay for their food. And this is people who are making 100, 150K with a career. They couldn't find a job. But one of the things that we realized is during that time, everybody paid their rent. They will bunch up, they will get 2 families into a house, and somehow they pay their rent. And we never had an issue renting a property. If you wasn't rented for $1,500, we'll rent it for $1,400, but it was never empty. In the meantime, the warehouse where we moved to have our office, it was half vacant. They couldn't give it away, right? And so at the end, residential real estate became kind of the safest asset class in our mind. I still think that it's the safest asset class. I wrote certain things about that. You can Google Danny Kattan at Forbes. In Forbes, I actually wrote a piece about what can we learn about Star Wars and real estate. And it turned out to be that the Millennium Falcon, which is the Han Solo ship, had 7 beds. If you think about it, we're going like 10 times the speed of light. We're going through like black holes, and we still have beds with sheets on, right? So no matter what happens, you still have a place to sleep. It's future-proof, right? Correct. And so what we did is in 2018, we kind of like, as we were selling our portfolio, my partner Sol, which I forgot to mention, we brought him in like a couple of years after we started with Jimmy. He started, he started to create the multifamily platform. And one of the things that we said is that let's create a platform where investors can come and invest with us and be very, very tight about it, be extremely conservative. So some rules, we don't take financial engineering, right? The cow is worth the milk it gives. Again, back to basic, buy below replacement value, buy in secondary and tertiary cities that are growing. So we left South Florida and Miami, and we bought our first apartment in Pensacola. And then COVID came, and that's when Miami got crazy and South Florida got crazy. But just a reminder, in 2020, in January, there was 6 years worth of inventory in South Florida. And somehow all those developers were saved by COVID. And then people realized, you know what, the free state of Florida is a good place to come work and no taxes, and somehow different mentality. And so we had this unbelievable ride. But knowing what we know today, it would have been hard to sell the properties in 2018 because what we sold for $250, now it's worth $500. So we left a lot of money on the table. But the reality is that with the analysis we made in 2018, we realized that we never left anything out. So it was the correct analysis, okay? COVID took over and somehow the world became crazy. And risk went out of it. Like for the 6 months and the first 12 months, everything was about risk, and then people forgot about it. We bought a property in Jacksonville, and by the way, everything that we bought, it was a GPLP structure, multifamily. Our buy box is 7% cash on cash, 15% IRR, net of fees. Very conservative underwriting with no financial engineering. And then 2021, it just became very hard to buy because suddenly, you had the rise of the casual LP investor who thought that they knew a lot. And we were talking about this. You mentioned a term. What did you say?
I said amateur LP, but I don't know if that's an appropriate term for the recorded podcast, although it's now recorded. But yes, you're right. It's someone, I think there was a lot of folks who had made a lot of money during the COVID time, the Bitcoin, the crypto, all of this, and asset prices were going through the roof everywhere. And so there's a lot of liquidity, Federal Reserve pushing a lot of money into the market. And so people were taking that money and they were putting it anywhere. And that included real estate, and that included multifamily apartments, that included self-storage, that included all sorts of things that, has a cycle and doesn't always go up and to the right. But I think people invested with the expectation that, the ride was going to go on forever. The music was never going to stop. And there's certainly, I think some of those people are certainly licking their wounds now.
Yes. And more than the asset class, it had to do with the risk people took to get there. So LPs.
Money, talk a little bit about that, because I think that's absolutely right. I think the way people were buying the deals, it wasn't so much that the asset class itself, it wasn't the fundamentals of real estate, the fundamentals of apartments that were the issue. It was how people were getting these deals done. I don't know if you could speak a little bit to that.
Yeah, sure. So one of the frustrations is that we are very sort of down to earth, very structured people, very corporate. We say that we're not in the real estate business. We're in the asset preservation business, and we do it through real estate. Right. And at the end, if you buy it well, you're going to get good returns, low turn. So one of the first things that we did is we said, you know what, we're never going to do variable debt, because we don't know what the bond's going to be in 5 years from now. If we did, we would not be doing real estate, right? It will be presumptuous for an investor to say, well, we're going to buy these things with variable debt, and in 3 years, we're going to cash out, and, like nothing's happened, right? You got all these people who wrote in Excel, models that did not make sense. But I always said that, more science fiction has been written in Excel than in Word. And we were sort of at some point, we're trying to buy these properties, and we're competing with people who are overpaying for them. And the reality is that the only people that could do that is if you actually started pushing the boundaries of risk. And then we realized that is being pitched to the investor as if risk did not exist. And the investor that is not sophisticated, because a doctor is not supposed to know much about real estate. I want the doctor to know more about medicine than real estate, right? They just bought it, right? Oh, 22% IRR, great. Like, they don't have a clue what IRR is. Or 30% return, it's a nominal return, right? 10% cash on cash, it's not an average. If it's a weighted average, it was like probably 3 or 4. And so a lot of these people just bought into these structures that were very financially engineered. And, truly, I started feeling like we were doing something wrong, right? Like in 2022, we underwrote 850 properties. In the Southeast workforce, we underwrote it. And I remember one of the brokers saying, what, guys, you're not doing variable financing. Don't be idiots, do variable financing. That way you will more, the numbers will make sense. It's like, well, first of all, we're not in the variable financing game. It's fixed fee, it's fixed financing, 10 years long. It is what it is. We don't play in that game until somebody's going to get hurt, in the same way people got hurt in 2008. So we keep on forgetting the story. And I think that the sad story about this is that a lot of people not only got hurt, but got hurt really badly. Like, I know LPs who are not only not getting the returns, but losing 100% of the money. And so I think that we're going through that dynamic. A lot of people saying, well, Danny, is there going to be distressed? And my answer to that is there will be distressed sellers, but there's not going to be any distressed pricing. The pricing will reflect the level of distress of the property. But in 2008, 9, 10, 11, 12, we were buying properties, and we were getting calls from the banks and saying, hey, can you buy 3 more? What price? Whatever price you put. Okay, take it, right? I once got a call from a broker. Says, Danny, I have a multifamily in the corner of bad and worst, war zone, but it has an attaching lien that is affecting a property that I'm selling. And so I know you're a fair guy. Give me a number that works for you. And in the phone, I'm like, okay, $8,000 per unit. He goes, done, right? And it was it was probably worth 12, right? Not like it was a fair. And my point is that today, in this day and age, you don't have situations where somebody's selling something and there's only one bidder for it. There's a lot of liquidity in the market, extreme liquidity. Now you have first mortgages, second mortgages, preferred equity, mezzanine, everything that you want. When we first got debt for our single family homes, and this was probably 2010, man, it was just like we had to sign our guarantees, sign our dollars away. It's like, 50% loan to value. This was a, 2.5 DSCR, and the banks were like scared. Now they're throwing money into you. And so I do believe that this is a very safe asset class. I do believe that it's future proof. You have to make sure that you buy where the jobs are going to be, and that's why we like the Southeast. You have to make sure that you buy cash flow and then some sort of appreciation. And that's why we create alpha. So, our strategy, we started with one property in Pensacola, then Jacksonville, we bought Savannah, Georgia, Fayetteville. And then after the fourth one, we got a bunch of calls from our investors, which, by the way, most of them are high net worth individual, family offices that are very institutional thinking. They're like, guys, we got 4 out of 4, do a fund. And so we launched our PIA Residential Fund, and we bought through that fund 2 more properties, one in Birmingham and one in a place called McDonough, Georgia. As we grew up, we also had some people come to us and said, hey, Danny, we're buying, as we were selling the single families as multifamily, we met some people that needed some seller financing. And so we created some hard money lending. And now we also have a hard money lending fund. So we're paying about 8.5% to people who invest with us. And in that, we do only in South Florida and Georgia. We do it only with single families and small multifamily. It's assets that we know that if tomorrow we have to get the asset, we exactly know what we're taking. Like, I wouldn't do anything that we don't know. And I think that is also, we're very risk adjusted, right? It's risk. You identify risk. Our job as investors is to identify risk, learn how to mitigate it, take it out of the table, and give you, a smooth sort of return as possible, and create value by bringing alpha to the table.
Yeah. Just you said, I took so many notes as you were talking, and I didn't want to interrupt you because you were on a roll. So I'm just going to go back to a couple of things that you said.
Sure.
So when you think about how you buy properties, you're looking for ones that are below replacement costs, where the cap rate is above the financing rate, which today people are calling that positive leverage, and then you're looking at that buy versus rent decision, and that's how you're determining if real estate is kind of cheap or expensive as an investment opportunity, right? And then you're currently looking for properties, secondary and tertiary markets, primarily the Southeast. You started, and that's going to be looking for about a 7% cash on cash yield on average. It sounded like you're a long-term holder, so you're getting long-term
5
financing.
years.
Yep, okay. And you're looking for about a mid-teens IRR and no variable debt. So there was that time between, early 21 and about now, basically, that you couldn't really do that many deals. Well, not about now. If maybe a year ago, it started to make sense again to do agency financing or to do fixed rate financing. At least what I'm seeing in the market is that you're starting to be able to get more and more purchase leverage as the cap rates are coming up and rates are coming down a little bit. And there's not as many bridge financing or variable financing players out there you're competing against. So we're seeing, for us, for the deals that we're bidding on, we would be off by 10, 15% during the variable rate days, right? These syndicators would come in and they'd be 15% higher than us because we would be looking at deals with agency financing. And now we're seeing that spread really come in a lot, where I may only lose a deal by 3 or 5%. And then that's just a question of maybe a different assumption around rent growth or expenses. It's not the whole capital structure.
I think that now you're not competing with the syndicators, because half of them are licking their wounds. Half of them are probably going to be in legal trouble, right? So again,
I think it's a lot of family offices, a lot of people who want to own the dirt for a long time, and they say, hey, this was $200 a door just 24 months ago. Now I can buy it for $140 or $150. Maybe it goes down a little bit more, but if I can buy it here, then I'm going to feel pretty good in 10 years.
Yeah, but let me stop you there, because we just finished the raise for a deal that we bought in McDonough, Georgia, and it was $21 million equity raise that we had to do, and we were assuming a loan, which is a bitch to do, by the way.
For the listeners here, this is Northern Atlanta, correct?
This is Southern Atlanta. This is between Atlanta and Savannah, actually. Right, it's on the road. This is so McDonough has 57 million square foot of warehouses, kind of a distribution hub. And we were buying 232 units at below replacement cost. We're assuming debt at 3.5%. Day one, 7% cash on cash. Right, and it's just like an extraordinary deal. And people are like, well, I can put my money in the bank at 5%. And we're like, no, you can't. You get 5 minus 40% taxes. You're at 3%. Okay, with no appreciation. But Michael, I'm releasing soon an article that's going to be called, cost basis is permanent, financing is temporary. Okay. And I think that the moment for buying multifamily, it's passing, because as rates will come down, you get a lot more people in the game. And so if you think about it, in 2022, it was okay to buy a property at, $250,000 per unit because you had positive leverage. Wow, the positive leverage. We have it at 7% cash on cash. But when you go and presented that same unit to somebody for 180, it was like, oh no, it has negative leverage, right? Well, but you're buying the property 30% lower, right? And I think that this is what a lot of people miss the boat, right? Which is they get pigeonholed into leverage or cash on cash or IRR. Sometimes I do like party tricks, right? So I go to a bunch of room of other investors and ask them like, hey, so I got a building at 6% and one at 4% cap rate. Which one should I buy? Most people, without thinking, go like the 6% one. I'm like, are you sure? Sure. 6 is better than 4. It's like, no, you haven't asked me the questions, right? Maybe the 4% stabilizes at an 8, right? So, there's a lot of other things. And I think that when people tend to look at just one item that describes the returns of that building or that property, they tend to miss a lot. And one of the things that they miss a lot is the sponsor. You know how many pitches I've done with people that ask me in about the business model and, this and the property and the Excel and the underwriting. Nobody's asked me about me. How do I think? What is my approach to risk, right? Why am I a better sponsor than the guy next door, right? And I think that is the most important thing when we invest in real estate. I mean, if you're going to buy it by yourself, great. But then you're eating whole what the broker is telling you. So you might not be having a sponsor, but the broker is basically telling you, buy this building because I'm going to make a commission, okay? And then the risk part. People just don't understand risk. I mean, I've been on top of roofs, unclogging toilets, unfortunately evicting people. Operations are risky, right? And when somebody tells me, I'm going to go buy a building, 200 units, I'm going to fix them, rehab them in 12 months to 18 months, I'm like, I call bullshit, because it's hard, right? Because if you want to do that, I'm not saying that you cannot do that, but that will generate forced vacancy. And forced vacancy, it's a risk because you might have forced vacancy in the middle of a downturn of the economy. You get caught with 20-30% of your building empty, right? You start violating some sort of loan covenants. And so everything, it's about risk. And I think that a lot of people in 2022, 21, 22, 23, forgot about risk. They were not pricing risk accordingly. And kind of the professional investors, we sat down and we said, you know what, we will only buy if it fits our box, and if it doesn't, it doesn't. And now we're starting to see more sort of like the bid and ask spread is coming together. And I think that that's where the opportunity lies.
Yeah, just a couple of things to point out there. I think from what you just said, in stocks and bonds, the evidence suggests that 80-90% of your returns come from the asset class, the choice that you make. Do you pick bonds? Do you pick stocks? When you do alternative investing, which includes real estate, it's the opposite. It's not about did you pick real estate or stocks or bonds. It's within real estate, who did you pick? It's all about the sponsor. And so people will say, you could take a bad deal with a good sponsor and turn it into an okay deal. But if you have a bad sponsor and a great deal, it's probably going to become an okay deal or a bad deal. And that's generally true in the alternative space when there is a lot of operational challenges. There's a lot of ops to be completed, beyond just the buy and the sell, right? When you buy a stock, you buy it and you sell it. You're not doing any of the operations. You're not managing the underlying business. But with real estate, you are managing the underlying business. And so if you're not a good manager of business, if you don't know how to drive performance, it doesn't matter how good of an opportunity you have, you're going to squander it. And so that operational focus is really important. And I'm going to ask you about that in a second. But you mentioned a bunch of times about risk versus reward, and you talked a little bit about operational risk, and we talked a little bit about capital structuring risk. Are there any other types of risks that you want to talk about? And the reason I ask that is because, to your point earlier, when a doctor sees a offering and they see a 15% return here, and then a 15% return from the 10 other, pitch decks they get, that 15% means different things in each deck, because you've got a turnaround project, you've got a value add, you've got a Class A lease up, you've got a Section 8 property, et cetera, et cetera. Every single one is different, but they all say 15%. Because that's what clears the market in the LP community, right? In the retail community. So why is that wrong? Why is that not the way to look at deals? How should LPs, how should your investors be thinking about risk and reward when they receive an offering from yourself or any of the other folks out there?
Okay, so let me get this thing clear. I'm a patient. I go to a doctor and says, doctor, right, I'm going to do this. I read about this operation that I can do on myself. And it's simple, right? It's, we're just going to take out, scalpel and open here and take something out and take it out. And the guy's going to be like, oh my God, you're an idiot. You have to sanitize it and this and that, and you're forgetting it. So a lot of the people who are not professional investors or who don't understand this very deeply assume that because they know business, they can understand what they're reading, okay? And I go back to what you were saying. People who know horses bet on the jockeys. They don't bet on the horse. I don't know horses, but that's what I bet. I'm an entrepreneur. I have started several companies. Some of them have failed, right? In a .com, I started a digital trading card company, and we actually sold technology to National Hockey League and McDonald's and all this stuff. But it failed. But the only reason we were able to do that is because we have an extraordinary team working for us. The timing wasn't correct. Here's the same thing. You have to bet on people who can understand operations and can do stuff when it hits the fan, because not everything is going to be all right. You can be the best of operators with the best of well-intentions, and a hurricane goes by, and now you're going to have to be in command of, 10 construction crews doing stuff. And this is a business, Michael, of boots on the ground and not Gucci's on the floor, okay? And with all due respect from the people from Wall Street, and I used to be a banker, you cannot be working for, let's say, a Blackstone, decide that tomorrow you're going to start buying multifamily without understanding operations. And operations is managing property managers, understanding how to set rents, understanding how to price rehabs, right? We have the best property management company available there. We were property managers. We realized that, for the multifamily strategy, we're going to go to the local property management companies and we're going to asset manage the property manager. And so you ask them for a budget on doing a turn in an apartment, and they'll send you 3 budgets, 11,000, 11,500, 10,800. And all I did was make a phone call from people that I know in Jacksonville and find the exact same work for 8,000. Because I know with my experience that 11,000 was expensive, right? So going back to all these things, right? I think that the first mistake people do is you're going to invest $100,000, $200,000, $300,000, and they don't engage a professional. I can look at a pitch deck and within 5 minutes tell you if it's right or if it's wrong. Just because of the amount of pages you have explaining and the opportunity and how many pages you have explaining, showing your math. Some of those pitch decks are not clear with fees because a lot of people are like, oh, okay, but it has an 8% preferred. Is that with a catch-up or without a catch-up? What's a catch-up? Well, if you don't know what a catch-up is, then don't talk about the preferred, right? In a catch-up, it's a very complex structure that a lot of people don't understand. Crap. Can you explain a catch-up to your grandmother? No. But can you explain a simple preferred 7% to your grandmother? Yes. Right? So a lot of people in the industry, create complex structures to get away from reality. And if you're a doctor or an architect or doctors, we always pick on them, and the doctors and the dentists, right? Call somebody who knows, man. I'm sure that if you're a doctor, a real estate investor. So it says, listen, give me 1 hour of your time. I'll give you 1 hour of my time. Just barter for it. Learn, right? Read, right? There's a lot of podcasts. I published already 4 months, an article in Forbes that talks about risk and reward and IRR and when a cap rate is not a cap rate, all those things. Feel free to, write me an email, Danny@PIAResidential.com, right? I got a lot of people like, hey, what do you think about this? It's not my deal. He's never going to invest with me, but I will gladly share with them because it allows me what people are doing. So going back to it, an IRR is not an IRR. It depends how you calculate it, what risk are you taking, it has good cash on cash during the beginning, and then at the end it's pure speculation or not. That's what we coined the term quality of IRR, which means that half of IRR should come from operations, half should come from speculation. Then the speculation part is, in year 5, I am going to sell this property at an X% cap rate because somehow I know what the world's going to look like in 5 years, and I know what the 10 years is going to be doing in 5 years. And I'm going to sell it at an NOI, whatever it is. That means that it's $350,000 per unit. And I'm like, are you kidding me? yes, your NOI is correct. Yes, your cap rate might be correct, but why will you sell at $350,000 per unit when today I can build it for $250,000? So replacement cost theory needs to be factored in. And one of the things that it's important for us when we look at long-term IRRs is when you sell it in the future, are you selling it at a discount to what you can buy it new today? And so it's just too many moving parts to say there's one thing. All I'm going to say is go figure out who you can ask, and if not, pay for advice and sit down and make sure that, by the way, forget about the numbers. There's a lot more devil in the details in the subscription agreement. So there's subscription agreements that after a 25% IRR is like 95% for the sponsor, 5% for the LP. It's a lot of things.
Yeah, no, that's definitely good. Just for listeners, catch up preferred is basically if you don't make the preferred in the first year, you have to catch up and pay that off before the sponsor gets paid in the future. But it can be calculated a number of different ways. It could be simple interest, it could be compounding, and you've got to be careful about all of that. So you may be enticed by a very high high preferred, but if the sponsor can never deliver that preferred, then they're always catching up and they're always out of the money.
And there's always the catch up part where it means that, if I pay a preferred to the LP, then I can pay 50% of that preferred to me, and then
there's a bunch of different ways, to get there, right? You can have waterfalls inside of your waterfalls, and then it's very complicated, right? And then even the reporting structure becomes so complicated, and you're paying all these fees for administrative accounting things that end up getting billed back to the LPs ultimately. And then reading the docs, I think that's a really important point. What it says in the glossy presentation, the colored presentation, is not necessarily 100% the deal. It's subject to change, and everything is governed by those legal documents that are signed a couple days before closing. And so that's really super critical. It's not the PowerPoint presentation. That's the sizzle, but you gotta read the docs. You talked about IRR being a misleading term because, or not term, but variable in that, you can have time weighted. So if the cash is front weighted, you can have a higher IRR. And then if you rely a lot on your exit for your returns, then you could really be juicing your IRRs. And I think the one thing that I think people, of all of those that people really don't look at, is that replacement cost at exit. They justify the cap rate. They justify, yes, this and this are right. But why am I paying 30% over replacement costs for a property that's 30 years old in a secondary market, right? So I think those are all really great things that people can take and then look at these documents and then at least have a sniff test, a few things they can look at to say, hey, is this something I should even consider looking into deeper? I'd also say to people, with a lot of the tools that are available today, the ChatGPTs and whatnot of the world, now this information can be inaccurate, but you can take these presentations, put them into ChatGPT, and ask ChatGPT to give you a set of questions. Not even answers, just questions. Hey, give me 20 questions that I should know the answers to before I should make this investment or before I should consider it. And just start having it quiz you. Make sure you're getting enough information. And then you can take those questions back to the sponsor. And then you have at least a good list to start with so you can learn, before you put your hard-earned money, in the hands of someone who maybe isn't totally aligned with you. I'd like to go back to the beginning of your career a little bit. You had you came into multifamily, but you started in single family, and you came up the hard ops way, the school of hard knocks, so to speak. So it sounds like you started in 2008, 2009 with these single family homes, and you were buying them pretty cheap, and then you ended up selling most of the portfolio. What at that time in 2018, I know you had talked about you liked housing, but why did you decide to not keep buying single family homes and to go into multifamily? Was it that cost per unit differential, or how did you think about, hey, we've had a lot of success in single family. You built a nice portfolio, you sold it. Why not just build another portfolio at that time of single families? And why switch over to multifamily
A couple of things. That's a very good question, Michael. So one of the issues with single family when we were building our portfolio was financing. It was very, very hard to get financing, right? And if you wanted to get non-recourse financing, it was even worse. So in 2012, when we started building the platform, we got approached again by Blackstone Invitation Homes. And we also, got approached by this ultra high net worth individual from Latin America that we knew. And he gave us $60 million to grow. And that's how we ended up, growing the platform. And so we became very institutional in the way we operated. But one of the things that he said is like, listen, whatever you're going to do, you're going to have to have non-recourse debt because I'm not signing. And so every time that you went to a bank and says, I want non-recourse debt for a single family portfolio, they'll crack out. They're like, dude, man, nothing. I remember a banker just saying, I know you came all the way here. We cannot do non-recourse. Thank you very much. There's some sodas in here, just feel free to take them. Stay here for as long as you want, but I'm not going to waste my time with you guys if it's not recourse. We never done a non-recourse. You will never, ever, 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 ever find a non-recourse loan in the city for that. Scrappy as we were, 3 months later, we found one. Right. And he was like, oh my God, it's a miracle. We found a recourse for a single family. In the meantime, the guys who were buying multifamily, they were like, Freddie and Fannie were just like throwing money at them. Right. And then it was the loan to value. And then there is the rate and the whole thing. Then Wall Street came out with the single family loan. I remember Eric Atlas, he was working for First Key, and First Key came with his product of finally you can, we're going to give loans for portfolio single families. And when Eric announced that, he was like a rock star. He had like a line of people just waiting to talk to him. That happened in an IMN here in Miami, in Doral. So remember that day. And I'm like, okay, maybe this is the beginning of having more leverage for this industry. And it turned out to be, we went to Washington and we talked and we said, listen, it's very important for you guys to support the single family in the same way that you're supporting multifamily. And that's when it dawned on me that you're going to have a lot of, social pushback because there's a lot of people who think that the single family investors are taking the single families from the owner occupies. That is not correct. If it wasn't for the single family asset class, you still have thousands, if not tens of thousands or hundreds of thousands of blighted neighborhoods that were saved by us. Remember, nobody was buying these things. We're like scratching the earth to find people can give us money to go take a property in the middle of, Miami Gardens, which basically was destroyed. Okay. We fixed them, we built them, we brought in tenants and everybody says right now, oh, you know what? The single family aggregators, institutions are competing. No, it's 3% of the market, 2% of the market. They're bringing a professionalism that now allows a person who does not want to buy and he wants to be a renter, he or she wants to be a renter by choice, to live in a house that is professionally managed. But guess what? There's 16 million mom and pop investors who are still buying properties. And they do that because they say, you know what? Maybe I don't believe in Wall Street. Maybe I want to own my own property. And by the way, because I want to touch the brick I have and I want to be able to rent it, so long term, this is a good business. And so the reason kind of we moved away from single family in 2018, although in 2018 already existed plenty of debt facilities, is that it was very hard to compete with the Wall Street funds because they were competing cost of capital and they already had the machine going. But number two is just we didn't believe there was no trade anymore. I mean, just single family is a very, very, very hard asset class. And we are looking like geniuses right now because, we made it and, we bought houses for 110 that now we're 220. But listen, we made a lot of screw ups that we were saved by the appreciation. When you're buying houses at a 5.5%, 5% cap rate and your cost of money is 5, you don't have that much time, right? And so we kind of moved to multifamily where we thought we had better alpha, that we can create better alpha. You can deploy one check, You want to get debt, you got people calling you and offering you all sorts of favors to do debt with them. Debt is cheaper. And we had a better sort of thesis. Buying below replacement cost is the thesis. Buying at, occupied where you have workforce that are arriving or migrating to that market because there are jobs opening up. It's the thesis. Jobs are opening up because people are migrating there. That's the thesis. The rest is easy. You just wait because at the end, people need a place to live. So we felt very comfortable with that. And in 2018, that's when we pivoted.
Yeah. So basically, I think, you're looking at you're obviously looking at migration trends, you're looking at population growth, you're looking at housing as a necessity, something that people need no matter what. So that's going to narrow you down to housing, right? Because you're going to be in the right markets and you could be in single or multi. But I think what you said about why you like multi is that you can allocate a bigger amount of equity per deal. You can get more units on the same piece of dirt, so you get some more diversification. And you don't have to just buy at a 5.5 cap and finance at a 5. You can buy at a 5.5 cap and bring it to a 7, an 8, a 9. So you can create a lot of NOI growth and create a spread between the market cap rate and your cap rate by improving the asset or doing some sort of value add, which in single family is you can do it, but it's not really how single family is priced. It's really more based on sales comparables.
Yes, correct. That's the other thing, right? I mean, a lot of people said, oh, you know what? I have a X% cap rate on my single family portfolio. Like, no, you don't. Mm-hmm. You bought it cheap. You think you have it there. And now do me a favor, let's price it to market. Mm-hmm. And that's when you realize, you know what? It's cheap. It's better for me if I take the money out and put it in a hard money lending fund like ours. I'll pay you 8.5, 9. Right. And you don't have to work hard for it. Oh, but there's appreciation. How much more appreciation are you going to have in a house that right now is worth $500,000 in the middle of the boonies in Miami? Right.
Mm-hmm. I mean, right. Especially if you bought it for 100 and something, right? Because you have that implied equity, and it's like, okay, even if it goes up another 100,000, you're still already up 300 or 400. So why take the risk of going up 25 when you can still go down 75, right? The risk return. I don't think we're gonna see a downturn though. Like I really don't think that there's gonna be a little bit of correction. But my point is that same house to build it is worth 400. You sell it for 500. It's 20 years old, right? Mm-hmm. If you believe that house is worth 500, and it is because that's what the market's paying, then do me a favor, sell it. Yeah, buy a lot next door and for 400 and do the 400
and buy a new and sell a new one for 600.
Mm-hmm. Which is the same calculus you can do in multifamily. You say, hey, if I can buy this for 150, why, and sell it for 300 and I can rebuild it for 250, then what's the question? Of course I'm going to sell that 300 if I can rebuild a brand new for 250.
Here's the thing on single family, and I'm going to pivot very quickly to sell-to-rent because I know where it's worth. So single family, for me, it's still a great business for the mom and pop who are okay managing themselves. Okay. Something goes wrong, they'll send their friends, in a truck to fix it, right? When single family starts to become institutionalized and you have to use a property manager and, you start losing track of the things, there is no economies of scale in single family, except insurance and cost of capital. The rest is economies of this scale, like inverse, right? I can send to fix my apartment, Lionel, right? Which is, my Q1 friend who has a truck and fix air conditioners. And he's going to charge me half of what I have to do if I have to use a property management company. And so single family as a means to create wealth for the individual investor is still there. The hard part was the tenant. It's always been the tenant. Okay. It's about if you get a great tenant, you're going to have no problems. You get a bad tenant, oh my God, right? There's nothing in this world you can do to save you from a bad tenant. And trust me, we've got plenty of bad tenants. So in 2018, one of the things that came to me, and this came from visiting a lot of houses. As I told you, I walked into 6,000 homes to buy 400. And I'm a father of 3 girls now, but back then it was 2. And there were newborns. And every time I walked into a house where a family got evicted, you kind of feel the bad vibes, right? And it got really to my heart when you walked in and you saw the pink rooms and the blue rooms where people were like, oh my God, right? You realize that there's some kids here. And I said to myself, you know what? It's not fair. This is a family who was living here. The bank came in, basically foreclosed on them, let them stay in the house, take the house away, but, make them renters. And so I figured that this was an opportunity. But then again, let's go buy houses again. And we forgot about that idea. When I sold the portfolio, that's when it occurred to me that, there's an opportunity there to create a platform to allow people to sell their house, cash out, and stay as a renter. And that's when sell-to-rent came in. And basically sell-to-rent, what we do is we pair homeowners that are, in need of cash, either because of divorce or, they need money for their business or for health, or simply because they got tired of, running their house, or they want to retire and want to move to Florida. So we pair them with investors who will buy their property and, cash them out and allow them to stay as a renter. And we talked to a lot of mom and pop investors who are getting into this. It's like, oh my God, if you can provide a renter who will treat the house as their own, I'm in. And so I do believe that the leaseback category will be a huge category in the future. When I conceived the idea, I'm like, well, this is a leaseback. The largest asset class in the world by far, is single-family residential. And I said, like, wait, you can do a leaseback on a locomotive and a photocopier? You cannot do it in a house? It must be illegal. That's my first thing, right? And like, you're like, no, it's legal. And that's when I said, it's a huge problem that we're trying to solve. And we solve it, and we created Sell to Rent, which is an amazing company. We have about 30 people working there. And, we're doing transactions everywhere in the United States. So I'm happy to say that I'm doing my part to incentivize single family as an investment.
That's wonderful. I think right there, we're a little over on time. So we'll, if before we leave our listeners here, is there anything any last nugget of wisdom or anything else you want to mention that we weren't able to touch on, yet?
Goes back to the same message. It's about risk. If you don't know real estate, find out somebody who will. They can, don't make investments without consulting somebody who can understand, they can translate for you. Feel free to reach out to me, Danny at PIAResidential.com. You can Google me, LinkedIn, the whole thing. But I've seen a lot more money being lost by people who work hard for their money because they take decisions that they don't know anything about. And so that would be the pearl of wisdom. Whatever you're doing, regardless of whether you're investing in real estate or, whatever, cars, whatever it is, just, always get advice.
Yeah. So knowledge is power, basically. And I think today's...
Knowledge is not power. Knowing who to call is power.
Okay. All right.
This is your
network is your network. I guess is the other.
Yes.
Your network is your network. Yeah.
Power is having a network of people you know how to call.
Sure. Yes.
Right?
Yeah.
Because I don't know anything.
Sure. I think you might be understating what you know a few things about a few things, I think.
Very specialized, but not about everything. That's
Sure.
when I have a problem, I call my doctor.
Right. There you go. Well, no, I think that's a great piece of advice to leave with the listeners. Danny, thank you so much for your time and for sharing some great insights and knowledge
Michael.
within the real estate space. If our listeners wanted to get in touch with you or find out more about your work at PIA Residential or your other company, rent2sell.com.
Sell to rent.
Oh, excuse me. My apologies. If they wanted to find out more about your other company, sell2rent.com, where can they go to find you?
Well, just go to the website, PIA Residential, Sell to Rent, or drop me an email, Danny at PIAResidential.com or Danny at Sell2Rent.com. I'm always on LinkedIn. I accept any invitation people give me. I'm an open networker. Because you never know who you need to know, right?
Absolutely. You never know who you need to know. So great. Well, thank you for tuning into this episode of Deal Flow with me, Michael Pulio. Don't forget to give the podcast a follow on Apple Music and Spotify and subscribe on YouTube so you don't miss an episode. And of course, if you feel like someone else would get something out of this show, please go ahead and send it across to them. Feel free to comment below with regards to future guests you'd like to see on the show or get in touch should you think your knowledge and expertise would make for a great episode. Thanks again from me and see you next time on Deal Flow.
Thank you, Michael. Thank you, listeners.
All right.